We're sort of getting into earnings season in quite full swing, both in Europe and the US, Mike. What key metrics are you looking for in terms of the sort of sectors you'd be attracted to at this point? Is it those that are high cash flow generative? Is it that you're looking for quality growth? What are you looking for?
Yeah, so we want at the moment good quality stocks, strong balance sheets, high cash flow generative, as you said, and value. So you look at that in the US, and a lot of financials tick the boxes. So they've got strong balance sheets. They're now about double the capital they had relative to 2007. They're generating lots of cash flow that's allowing them to buy back stock. And therefore, they tick the quality box, and they're also cheap. So they trade on a PE, the financial sector, about 12 times relative to the wider stock market of about 17 times. So we think that financials tick those boxes. Also large cap, so large cap over small cap at the moment, given the two-way risk to the economy. In Europe, we're broadly sector neutral, actually, at the moment. Some small underweights to some of the industrial stocks, tech stocks, for example. So a slightly more defensive bias within the European portfolios. But yeah, broadly speaking, value and quality is what we're looking for, and large cap as well.
In terms of the Japanification of Europe, I had a really interesting conversation with Coco Aboblua of Société Générale, who talked about the zombification of companies in Europe. Do you think that theme of Japanification in Europe is a little overdone when it comes to the corporate space?
Yeah, I think it is. So ultimately, Japanification to me describes a world where you had a credit crunch that lasted for the best part of a decade. So from 1996 through to 2006, you had year-on-year credit contracting every single year. So to compare Europe to Japan of the late 90s, early 2000s is unfair. Today, you've got pretty healthy credit growth in places like Germany and France. Where I think it's a fair comparison is for some of the economies like Italy, for example, where credit growth has been much weaker. Now, obviously, they've got the same demographic drags in that Japan has already experienced aging. That's something that Europe is going to face. But I think it's really all about credit. And in Europe, it's just Italy and Spain where the credit growth is weak, whereas in France and Germany, you're not seeing that.
Mike Bell, I was thunderstruck this weekend by not the gloomy tone, but just the dampen, the blanket, the quiet of estimates of what equities will do from here forward. Color the wall of worry right now. To me, it's remarkable the tendency towards caution.
Yeah, look, I think if you look at the world at the moment, what everyone is struggling with is the fact that the business surveys are pretty weak, so particularly in the manufacturing sector. And they're at a point whereby they could pick up. If you look in the US, for example, the Philly Fed survey bounced really quite strongly. The Empire survey less so, but nevertheless picked up a little bit. And so for the optimists out there, that's giving them hope that you're going to start to see a turnaround in the business cycle. And when the business surveys pick up from these pretty weak levels of around 50, then it tends to be pretty positive for risk assets. So I think that's the positive scenario. The obvious negative scenario is that they don't pick up and the data continues to deteriorate. And if that happens from this level of weakness that we're at the moment with, for example, the manufacturing surveys, that tends to presage a pretty negative outlook for the economy. So I think it just creates an environment where it's very difficult to take big overweight or underweight positions, given that fundamental uncertainty at the moment.